Hello and welcome to the Monday Futures Market Outlook for September 10th, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out eminisource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures, and on Friday we had a very material breakdown that is very significant. We were part of our thesis overall about a strong bullish US dollar was really relying on the idea that the primary uptrend would remain intact, and there was a trend line that's not evident here that connected along all those bottoms. And the breakdown that we had here on the jobs numbers really has put a dent into that thesis. At this juncture, it certainly may be a limited risk-reward proposition for continuing to short the US dollar, but really we have to now ask ourselves, the story that we've had for the whole year of a bullish US dollar, really has that all come to an end? This would have very material impact on the prices of commodities and which way they will trend going forward. You'll see that as this US dollar broke down, it also led to a breakout in copper and other things that may lead to a change in the entire intermarket landscape. We're going to be focusing on this storyline quite a bit in the upcoming weeks to really see what has really changed here. Nonetheless, while we do again see now the potential for a test not only of $80, but there could also be a test of all those lows around 78, 79 on the downside. But we do believe that chasing this here has to be for swing traders or day traders where you're in and out in reasonable periods of time. At some point we will get a bounce, but that bounce is going to tell us a lot, and it's really going to set up for whether or not something bigger picture is going to happen. Next year I want to take a look at that Euro FX futures, and this also was a very material breakout on the upside for the Euro. We were suggesting those highs of June were going to be a substantial overhead resistance, and the Euro seemed to cut through it like a hot knife through butter. At this juncture, that doesn't necessarily mean that the Euro is going to be able to gain huge momentum on the very short term, but if we get good healthy consolidations that validify this breakout on the upside, then there could be a scenario where not only have we seen this year's bottom for the Euro, but could lead to an extended period of consolidation in the Euro between, let's say, the 130 to 125 range, and then we could more or less stay there even for the remainder of the year, barring some massive news catalyst. Nonetheless, this is material because it is one of the reasons the U.S. dollar was so strong was the Euro weakness, and this Euro breakout is certainly what caused that substantial breakdown in the U.S. dollar. And so we're going to again continue to watch how this consolidates and whether or not it creates a continuation pattern to suggest that the trend will continue for the remainder of September. Next year I want to take a look at the 30-year Treasury bond, and the 30-year Treasury bond is at a very huge pivotal moment. We tried to be optimistic that there was going to be some further bullish breakouts on the upside, but right now the Treasury bonds have had reached a point of substantial overhead resistance right along the 152 level where all the highs came in May and July. Really at this stage this could become some form of a topping formation if the Treasury bonds cannot break to higher highs, and so we remain relatively neutral here, because if the 30-year Treasury bond can gain momentum and get back up to those highs or even push higher, it would certainly allow the opportunity for them to make another move. But at the equal degree, if we saw Treasury bonds wipe out this entire rally and move right back down to that 145, 146 level where those bottoms came in just in the month of August, then we would start seeing price action that would not only be range bound but could be very toppy, and that would be very significant in the bigger picture. We're going to reserve the right to change our opinion over the upcoming weeks, but see no need to at this point abandon our bigger picture technical observations at this juncture. Next here I want to take a look at a chart of copper, and this is where we can see the effects of on commodity prices from what happened in the US dollar. when the U.S. dollar broke its trend line in a primary move lower. Copper made that bullish breakout. This is substantial. The move in copper will be directly correlated to what will end up happening in the U.S. dollar and the euro. But if copper here continues to consolidate now above the 355 level, and with flags and wedges holding up there and price action consolidating up there, we may have for the first time seen the potential of now a bullish copper environment that may pertain like or sustain itself like that throughout the remainder of the year. Next year, I want to take a look at a chart on crude oil. And for the longest time, we've been watching for whether this rising wedge would end up breaking down crude. Crude has actually remained relatively within its range, but this is going to be a pivotal moment with the U.S. dollar breakdown and breakouts and things like copper. Instead of this being a breakdown wedge, we may end up seeing this as a consolidating flag that may actually bullishly break out here. And so we're very neutral here, really at this point. A break to lower lows below 94, we'd be open to the idea that there needs to be a pullback even as low as $90 or $88 on the downside. But here, a breakout above $98 really at this point would solidify an upside breakout that could see at minimum 102, but even as high as 105, 106 on the upside. So there definitely is the potential to trade in both directions right out of this very small consolidation we've seen for the last 3 weeks. So a bullish break on the upside will be trading higher, and a bearish one lower. This is a very clean setup that is going to be actionable for trade opportunities. Next year, let's take a look at that chart of gold, and gold as well has made a material bullish breakout on that U.S. dollar breakdown. We have now are approaching those highs that we put in February, then the highs of the year. This turnaround in gold has been very material, and it certainly is putting further support on that scenario of a weak U.S. dollar and strong commodity markets. Really at this stage we are looking for overhead resistance along the previous highs. So at this point, buying gold today has a limited risk reward payoff, but so long as old pullbacks on gold behave, we will continue to be looking for whether or not gold will remain in bull trend. That brings us to wanting to analyze the S&P 500, and the S&P 500 as well had a very bullish break of that little flagging formation that we've been talking about that happened over the most of the month of August on the downside. Really at this stage, we do believe that there is only marginal upside potential on the short term. We'll be looking for highs as low as this level right here at 1440, but we could see even a push as high as 1470 on the upside. Then at some point within this range we'll begin a consolidation that will tell a lot of very valuable information in regards to what's in store for the market. If we see let's say a high coming at 1450 or 1460, and then we get a market correction that more or less contains itself to the 1400 level during the corrective phase, then may set up again for a very bullish move into Christmas or into the new year. One way or another, the upside potential of the market remains marginal, which makes our risk reward proposition poor. No matter how bullish things feel right now, we feel that anyone that goes into the market here is taking far more risk than there is the potential of gain, and that means that any of the traders that are trading higher here on the market should be swing traders and day traders. There's nothing wrong at this point of going into a stock and then selling it a week later for a profit. So we're looking at things from a much shorter time horizon for upside potential. But anyone here who's an investor that is looking to buying stocks from a longer term perspective, that is in the broader market, so not necessarily the commodity space which is turning around, but if you're in the generic high beta style stocks, at some juncture there is going to be overhead resistance that will meet some sort of a market correction. And so trade the markets carefully on a longer term perspective. On a short term, you can see if you can catch a little bit more. When we take a look at the key intermarket observations, what we want to emphasize here is that the long-term trend on the U.S. dollar now has to at least a minimum be range-bound. We're not whether we change that to now a downtrend would all be dependent on where the next rally goes. At some point, a short-term bottom will be banged out on the U.S. dollar, and when it does, where the market rally goes will determine whether we switch from the long-term range-bound trend now to a downtrend. The risk reward at this point of the U.S. dollar is good because it has sold off so hard that there at some point is only marginal downside risk versus the potential of a bounce higher. And so while we're not eager to rush off to tell people to be buying U.S. dollars at this point, the risk reward definitely is starting to favor the buying of U.S. dollars the weaker we get. With commodities, we're also changed from our primary bearish stance to a range-bound stance with all the turnarounds that we've seen at this point, including the copper was really the one that really made the bigger change. At this point, with so many of these commodities having made already the big moves, we think that the risk reward is only average here. As at some point there will be a break. There will be a point where they're going to all consolidate, and then that's when the risk reward proposition will become good again. So anyone here chasing commodities, recognize that in the bigger picture you might be all right, but on the short term there might end up being a better buying opportunity for those that are patient for those pullbacks. Now this next one on U.S. bonds is where we're going to where we've seen that breakdown really rolling over. But before we again become try to put an end to the long-term trend higher, we need to see price action weaken still here. Therefore, the idea of buying bonds at this juncture still actually is pretty good at this level from how much risk you have to take. Obviously, if bonds break down, you would take a loss, having to stop yourself out. But at this stage, the risk-reward proposition is good versus the upside versus how much you have to risk to find out whether you're right or wrong. Now, when we get into stocks, both U.S. and global stocks, the global stock markets, like the European markets, are strong, but the Asian markets are weak. So we classify it as a mix for trend. But the U.S. markets are definitely in an uptrend. But we are increasingly seeing a poor risk-reward proposition for continuing to chase this market. It doesn't mean that over the next 6 months there won't be opportunities to make money in the stock market. It just means rushing to buy the markets here at this juncture is an increasingly poor risk-reward payoff for doing so. So we're sort of at a very mixed change in the markets. The U.S. dollar bull has been something that's been sticking with us for the entire year, and same with bearish commodities has been with us the whole year. And so we may actually be observing a substantial change in the intermarket landscape that we have to now be able to adapt to as it changes in the upcoming 30 to 60 days. That was your Monday Futures Market Outlook. Thank you for joining me.